There are signs the U.S. economy may be healthier, I should say, than some economists thought. Industrial production rose 0.9% in July, marking its biggest increase so far this year. And many companies continue beating expectations, and that includes Target, Macy's, and Home Depot. Well, joining us right now to talk about where exactly the economy is headed is Chris Rupkey. He's chief financial economist over at Bank of Tokyo-Mitsubishi. Also with us, Jeff Frankel. He's professor of international finance at Harvard's Kennedy School of Government. Gentlemen, welcome to Street Smart. And Chris, I want to kick it off with you. If I had $1 for every time I heard double dip back to recession over the last month or so, I'd be fairly wealthy. You don't think that's where we're headed, though?
Well, it would be very abnormal. We're barely 2 years out of this recession, and to think we could double dip here, I don't think it's really happened in modern economic history, which has taken place since I've been an economist since the 70s. So
even though things have been slowing, you know those GDP numbers earlier this year, even though things have been slowing.
I think we get to this idea that the economy has some sort of stall speed. There's been research showing that if GDP is running, it was 3% last year. If it slows to about 1% in the first half of the year where it is now, bad things can happen. That is recession. We can drop away. But all the recessions have pretty much been caused by the Fed tightening credit, and they've been loosening credit for 3 or 4 years now. So it's going to be very difficult to go into a recession. Not impossible, but difficult.
Professor Frankel, you also don't think that we're going to go into a new recession now, or at least you put the odds at less than 50%, but those are still pretty high odds, right? And you say they're getting higher, for example, higher than they were 6 months ago.
Yes, I mean, they've gotten worse over the last 6 months. I suppose now, if you forced me to say a number, it would be something like 35% possibility. I mean, just in the last few days, we've seen some good news. As you mentioned, industrial production, the last employment report, and you know, some other good news in the last few days. But the overall message has been really the same for 5 years, which was that was a very severe recession, and the very nature of it meant that from the beginning it was baked in the cake that the recovery was going to be slow and uncertain. And I'm particularly thinking of the drag coming from two sectors, the construction sector and the government sector.
And, you know, it's interesting. I mean, you teach at the Kennedy School of Government there at Harvard. You say were it not for political constraints, we would have an obvious solution to our economic malaise. What is that?
Yes, and I think most economists of both political parties, not politicians, but economists, would agree that this is a superior path. The solution would be simultaneously do two things that are hard to hold in your mind at one time. Simultaneously commit in a credible, serious way to long-term progress towards fiscal consolidation. Not just give speeches and rhetoric, but do things like to lock in the slowing the rate of growth of discretionary spending, of entitlements, raise tax revenues, all that, and at the same time undertake some short-term fiscal stimulus, like extending Obama's payroll tax cut and letting the state and local governments spend more money so they don't have to keep laying off workers. Do both of those things at the same time. That would be better than what we're doing. It'd be better than what the Republicans want to do by themselves, better than what the Democrats want to do by themselves, better than any likely alternatives we're going to come up with.
Well, let's see what we get out of Washington, whether or not we'll get some significant policy changes here. What I want to get back to, though, a little bit is what the Fed may or may not do. We did talk with Philadelphia Fed Bank President Charles Plosser, and here's what he had to say about the U.S. economy on Bloomberg TV earlier today. Listen up.
I thought our statement was too negative on the economy. I thought that it was a too dire outlook, and I was worried about undermining confidence in the process. Most people were expecting growth to pick up somewhat in the second half, that we were not expecting another recession, and that we run the risk of undermining confidence.
All right. So, Chris, you know, we've got Plosser saying maybe they were too tough in that statement. And he's also saying that we could see the Fed maybe need to tighten before mid-2013, despite what we got from them in their statement. Do you think that that's likely? And is the economy going to be strong enough to deal with it at that point?
Well, I'm just very afraid when some of the outliers on the FOMC start criticizing the central position of the FOMC, that's a dangerous situation in itself. I know he wants to be an honest broker and report what he felt took place at the meeting, but he's really shooting policy in the foot by saying the move to say we're going to keep rates low through mid-2013, it's not going to work. That was one headline. Right. That kind of shoots policy in its foot, and I think it's pretty ill-advised.
All right, but do you think we're soon ready to start raising rates when it comes to the
Well,
Fed?
on the other hand, I kind of agree with his position. I think the promise is one thing, but there's many broken promises in life, and this one wouldn't be such a bad thing. If the economy picks up, it's still conditional on the economy. If the economy picks up, if we create 750,000 jobs over 3 months, like we did in the 3 months ending April, that was an incredible achievement.
Right.
If that happens again, the Fed's going to have to start moving in the direction of taking away their easing.
A gigantic if, obviously. Adding that many jobs would be an amazing feat. Let me ask you, Professor Frankel, I mean, we hear other economists, I'm thinking of Christina Romer, prescribing exactly what you just said as well, as far as extending the sort of short-term stimulus. Do you think we're going to see that because the president's asking for it again today?
No, of course we're not going to see that. The American political system is thoroughly broken. There's no chance of seeing or I should say not much chance of seeing a really sensible fiscal policy.
Well, is there any chance of seeing, is there any chance of seeing 750,000 jobs created in three months' time?
Sure. I mean, any of these things are unpredictable. That, you go back to the Clinton administration, we did better than that year in, year out for 8 years. So it certainly could happen. But realistically speaking, what we're probably going to see is growth that is positive, so we don't go back into recession, and yet is not rapid enough to bring unemployment down very much. And even if we did bring unemployment down steadily, it would take us a few years before we got to the level of unemployment where we'd have to worry about it putting upward pressure on inflation. So I think the Fed is right. I mean, they're just going to have to leave interest rates low for 2 years.
I mean, Chris, safe to say that we're going to have to be pretty patient with the job cycle here. It's just going to take some time to get back to potentially the levels that we saw before the crisis.
Well, I think we keep having these rolling headwinds that keep hitting the economy. Yeah, it's going to take some time. I'm not in the recession camp, but I think after the shock of the economy with the Dow dropping 17.6% from the highs of the year last week, we have to kind of watch from this point going forward to see if businesses are nervous if they start to lay off people. So I'm going to be very interested in jobless claims, the weekly claims number tomorrow.
We talked earlier with Doug Cliggott about how important stimulus and quantitative easing has really been to the stock market. And I just want to bring in just quickly David Rosenberg, because he was on earlier of Gluskin, Sheff and Associates. He made the bearish case for the U.S. economy on Bloomberg TV. This actually happened yesterday. Listen up.
If you're driving through and looking through the front window of the car, the pattern of the data is very similar to pre-recession activity. There's no question about it in my view.
He has no doubt about it, Chris, that, he basically says if we didn't have all this stimulus and all this quantitative easing and so on and so forth, that we would already be in a double dip, in a double recession here. You don't buy that? You don't think all that stimulus kind of helped us?
Well, number one, we have the NBER on, Mr. Frankel, today. But, one of the signs of a recession is 3 consecutive monthly drops in non-farm payroll employment. Mm-hmm. Private jobs went up 154,000. The other thing to note is jobless claims starts going skyward very quickly because the economy is effectively going vertical. People just pull back. Unemployment claims are not doing that right now at this moment. We are not in a recession. I mean, you might want to look from this point forward each week, if you're pessimistic, to see if we're going into one, but it doesn't feel like one to me.
All right, doesn't feel like one. All right, we got to run. Chris, thank you so much. We appreciate your time. Chris Rupkey and also Jeff Frankel, professor of international finance over at Harvard Kennedy School of Government. We should point out, though, he was not speaking for the NBEA today, so we just want to point that out.